Good morning, everyone, and welcome back to our class. Today's topic is wash sale, definition, how it works, and purpose. So what is a wash sale? A wash sale refers to a transaction in which an investor sells a security at a loss and within a specific period repurchases a substantially identical security. This practice is subject to certain regulations, particularly in the context of tax laws. Here's a breakdown of how wash sales work and their purpose. Definition: sale at a loss. In a wash sale, the investor initially sells a security at a loss. Repurchase: the investor then repurchases a substantially identical security shortly before or after the sale. 30-day window. The wash sale rule typically applies when the investor engages in this process within a 30-day window, including the date of the sale and 30 days following it. How it works. Tax implications. The primary impact of a wash sale is on the tax treatment of the loss incurred. Normally, when an investor sells a security at a loss, they can use that loss to offset capital gains and potentially reduce their taxable income. Disallowed losses. In the case of a wash sale, the IRS, Internal Revenue Service, disallows the loss for tax purposes. Instead of recognizing the loss immediately, the disallowed loss is added to the cost basis of the repurchased security. Deferral of loss deduction. As a result, the investor doesn't get an immediate tax benefit from the loss. The loss is effectively deferred until the investor sells the repurchased security without triggering another wash sale. After taking you through the definition of a wash sale and how it works, let's now look at the purpose. Prevention of tax manipulation. The wash sale rule exists to prevent investors from manipulating their taxable income by selling securities at a loss for tax purposes while maintaining their market position through a repurchase. Fair taxation. The rule aims to ensure that investors genuinely experience a change in economic position when claiming a capital loss deduction for tax purposes. Now let's look at an example. Suppose an investor sells stock XYZ at a loss and then repurchases the same or a substantially identical stock within 30 days. The loss from the initial sale is disallowed for tax purposes, and the cost basis of the repurchased stock is adjusted by the amount of the disallowed loss. Output. It's crucial for investors to be aware of the wash sale rule and its implications to avoid unintentional violations and to plan their transactions strategically for tax efficiency. Consulting with a tax professional is advisable for personalized advice based on individual circumstances and the evolving tax landscape. Thank you for watching. Stay tuned.